So I would say, generally speaking, if you know all of your investors, 506B is super easy. Hey guys, welcome back to How to Invest in Commercial Real Estate. My name is Braden Cheek with the Criterion Fund, and I am joined by Brian Duck with the Criterion Fund and Joel Thompson with Precision Equity. What's up?
What's happening?
Episode 11, and we kind of got into offering on a property, but now that we're in it, I think we need to have some money. So how are people raising the money and kind of forming their entities, so to speak, when they're just starting out? A lot of people listening are probably flipping houses or have some rentals. They're probably using, their own money or close friends or something. So, what are people doing?
Yeah, if that's the case, if you just have yourself and maybe a family member, a son or daughter or something, and you guys want to pool your money and maybe you want to go out and buy a rent house or flip a house or something, in that case, you're probably pulling out an LLC. At least what I did is I formed an LLC.
Right.
I went to the state of Oklahoma and made an LLC. I wrote it up myself. Maybe people want to use an attorney. Attorney for just a simple LLC wouldn't cost much money.
Yeah.
Then I went to the IRS and got my EIN number, and away I went. So it was really simple.
Yeah, you don't need anything. I would highly advise getting an operating agreement and just saying, hey, who owns what and who put in what money and everything. But as long as you guys are working together for profits and you're both working, and one person isn't getting a disproportionately higher share of profits for a disproportionately higher share of work, then an operating agreement, you put the money in, you go buy the house, you flip it, you fix it, it's fine.
I found an operating agreement online and went through and modified it myself, and we all signed it, and away we went.
Super easy. No SEC, no governing board. I mean, it's just super easy. But this is how to invest in commercial real estate, not how to flip houses. So we're getting into the next phase. We need more money. We probably need more investors. We may need bigger checks than our cousin Joey, who's helping us flip this house. Joel, how are we going about that? That seems like it's got to be regulated more. Maybe you're getting a lot of investors. You may be getting a lot of money. How are you doing that?
Yeah. So let's talk about what a security is, because when you start taking money from third-party people, you are at risk of forming a security, and those have to be regulated by the SEC. So a little background, 1946 Supreme Court case, it's called the Howey test, and it basically says if someone invests money with an expectation of profit in a common enterprise where a third party is doing the work for them, they're the investor.
Right, they're passive.
They're passive, that's a security, and that has to be registered with the SEC and comes with a ton of regulation.
Wait, so a security has to be registered with the SEC. The SEC is the Securities and Exchange Commission. Okay, it's making sense.
Yeah, so, and in 2012, the Jobs Act kind of changed the game for raising equity with regard to that, and has two big caveats in the Regulation D, which kind of handles this. There's the 506B and the 506C.
Right.
So, go ahead.
Well, I think in 2012, the Jobs Act, I don't want to just pass over that. That was a big thing for our industry and fund managers, hedge funds, real estate funds, real estate syndicators, what we do. I mean, it's a big thing because the Job Act went and said you can go solicit for investments. You can go generally solicit, right?
Advertise your deals to the general public.
Wow.
Yeah.
I mean, that's massive when you think that before 2012, you couldn't do that, right? It was a relationship game. You were setting up a meeting with an investor or, however institutional they are. You were setting up a meeting. You were pitching your deal to them in person. There was no Instagram ads, Facebook ads. There was no advertising. You didn't put this deal on a billboard. Hey, invest in my new apartment complex I'm buying. I don't care if I know you, just invest.
Yeah.
That couldn't happen before 2012. And now it happens all the time. So I don't want to pass over it because 2012, that allowed people to go and just spam the general world and say, hey, give me your money. I buy things and I'm going to give you a return.
Mm-hmm. Yeah, it did one other thing. It also opened the door for non-accredited investors for the first time to have access to these types of investments. So now under 506B, you can have up to 35 non-accredited investors.
Non-accredited meaning what?
So accreditation is 200,000 in income.
If you're single.
If you're single, 300,000 married, and at least $1 million in net assets apart from your house.
Right.
That means you're accredited and you can take part in these types of investments because they're generally deemed as riskier, and you need some knowledge and you need to be able to take a financial hit if it doesn't go well.
Yeah.
So now you can take up to 35 what are called sophisticated investors. Don't have to be accredited, but maybe they can prove that they have the wherewithal to understand the investment. They're educated. Them personally, and they can come in on an investment like this.
And you said you could take 35 of those with a 506B.
So yeah, let's talk about 506B first. It's unlimited.
Because hold on, you can't do both. You can't do both. You can't do a B and a C. You can't say, hey, we're going to do both of these. You have to pick either or. So we're going to dive into B.
Yeah, and just so the people listening know, if you get into commercial real estate or you start raising capital, there are other avenues, but these are going to be the two most popular that syndicators and purchasers of commercial real estate use to raise capital. So the 506B, you can take unlimited accredited investors up to 35 sophisticated investors. That's number one.
Gotcha. So if they've got a net worth of $1 million, you can take as many of them as you want. But if you don't have a net worth of $1 million, you can only take 35.
Right.
Gotcha.
And another big thing is that under 506B, you cannot generally advertise the investment.
Yeah. So the easiest way for me to remember it is if I'm taking non-accredited investors, I cannot advertise.
Cannot advertise the investment. You can
Correct.
still advertise your company.
Amazing point.
Yeah. So you can say, hey, we've got deals. Don't talk about the deals. We got great deals, great returns. Sign up for our newsletter. Come meet us. Get them on your list. Then generally, you need to wait about 30 days. You need to at least have a phone call with them, understand their financial situation, allow them time to evaluate your company before you pitch them the deal.
Yeah, and kind of the hookup with that is with 506B, they talk about what's called the pre-existing relationship. So you're not allowed to advertise. So what the SEC says is, hey, since you can't advertise, you need to have a pre-existing relationship with all of your investors that you allow into this 506B offering. So this 30 days that you're talking about, this cool off period, that's just a reasonable step to prove to the SEC that while you were advertising, you were only advertising your company. And then at that point, that 30 days was you maybe building that pre-existing relationship, right? And then at that point, you can say, hey, they signed up for my email list. At that point, they got offered, several deals because they were my investor. They signed themselves up to the email list. That's not advertising. They solicited that to themselves. And then after about a month or so, then it's super easy to say, yeah, I have a pre-existing relationship with this person. They're allowed into my deal. I didn't advertise my deal to them. It still fits in that 506B mold.
Well, it gives them time to do their due diligence. So if they've, 30 days, maybe it's even, 100 days that they've been on your list receiving information, that now they are kind of without excuse that they did have a chance to evaluate you as a company, you as people, and your deal kind of before they decide to invest.
Yeah. So another one, Brian, when somebody's investing in a 506B, you're allowed to kind of, prove yourself that you're certified. So, we just went over that, but you don't have to do anything else, do you? I mean, if you're in a 506B offering, you can just say, I'm good as a person.
Yeah, you can self-certify, right? I mean, we send out a form, right, and then that people fill that out, and you can self-certify in that manner.
Yeah, but a 506B offering, you can just take their word for it, so to speak. Hey, are you an accredited investor and under these qualifications? They say yes, and you can believe them.
Yeah.
But I think that's a really good distinguishing point because in 506C, you cannot do that. They've got to have this third-party professional to verify their accreditation status. So, going back to 506B, what we're talking about, you're allowed 35 sophisticated investors. You're not allowed to advertise. You have to have that pre-existing relationship, and they're allowed to certify themselves as an accredited investor. So there's no extra steps. So I would say, generally speaking, if you know all of your investors, 506B is super easy.
506B is what we've used on the last 10 deals that we've done. raising equity from friends and family and people that we've met along the way.
That's what I was going to say. So when you first start out and it's your first deal, of course, you've done so many deals that you have a big list of investors that you know at this point, right? But when you're doing your first deal, is it going to have to be pretty much friends and family? Because that's really, that's who you know, right? I mean,
it very well could be. And the biggest test you need to make when you start, changing your investment strategy and you start adding investors is you need to start asking yourself, are my investors all limited? Are they doing any of the work? Am I getting maybe a little bit more money because I'm the one earning all of these profits for my friends and family and they're not doing anything, but I get a little extra chunk because I'm doing all the work? Then that's a security. You really need to get an attorney and you really need to fill out some documents, file them with the state, and we're going to go into that next. But that's a security. That's no longer this joint venture where you and your buddy are fixing this house up together, getting the same proportionate share of profits proportionate to the money you put in. That you can do an operating agreement for that. Mm-hmm. But when you start getting into these 506B and 506C, it's a good time for a disclaimer. We're not attorneys, even though Brian plays one on TV. We hire attorneys, and you have to get attorneys to draw up these documents, and you can recycle them. You can pay for them one time and then just have an attorney edit them. It gets much cheaper from there. But I mean, Joel, when they're doing a 506B, you're getting an attorney. You're getting some documents made. I mean, it's not a short stack of papers.
Yeah, I would say unless you have a friend that can lend you the documents and maybe an attorney friend that'll help you out for cheap, it is a reasonable step when you're going to go take other people's money and they're leaning on you for that profit. I would say expect $10,000, maybe more.
Yeah, I was going to say 10 to 15.
But that gives you the full suite of documents. They'll do the LLC for you, which is super easy, but they'll handle it. They'll do the operating agreement. They'll do a private placement memorandum, which explains the investment. What are some other ones?
Subscription agreement.
Subscription agreement, which details your investment for your shares.
Yeah, and it's a receipt kind of.
Yeah.
You get a joinder to the operating agreement, which just says you own shares of those operating agreement now. You may have to fill out some questionnaires asking if you've ever, declared bankruptcy or defaulted or lost money or, been in jail.
Yeah, a lot of disclosures for the investors.
Right. But generally speaking, we didn't write those documents. We hired attorneys to write those documents because when you're raising money and when you're dealing with the SEC under these exemptions, you need to have some security, and your investors want some security. And who wrote these documents?
Yeah, you want to make sure you're doing it right at that point. Your investors want to make sure everything's done correctly too.
Absolutely.
Yeah, and the attorney will file Form D with the state that you're investing in, or I don't know if it's where the property is or where all the investors are, each investor is, but
so you have to file a Form D in the state of in every state where you have investors.
Gotcha.
And you have to do that within 2 weeks of taking their money.
But once again, the attorneys will handle that for the flat fee that you've negotiated with them.
Exactly. And diving into that Form D and SEC, we said it's an exemption under the SEC. So the exemption is Regulation D, and then you can do either 506C or B under that exemption. But what that says is you don't have to file anything or be audited or be at the mercy of the SEC. You just have to do it properly with an attorney and then file a Form D. I know I just keep saying form names, right? And it's
well, so we'll stay out of the weeds on that. But what they need to know is we're going to do another show where we're going to have an attorney on, one that we've worked with, and we'll go through all this in a little bit more detail, just so people can fully understand it.
Yeah. So the other one, 506C. Let's get into the pros and cons about that versus B.
The main difference is that you get to generally advertise and solicit for investment to the general public.
So you can put an ad on Instagram of you flexing with your Lamborghini and your jet saying, invest with me. I buy the best deals ever
I know
anyone.
a couple of those guys. I've seen those ads. I guess you can do that.
So you can scream from the top of the mountain and say, hey guys, I'm buying this apartment complex. I want investors. And they can just, okay, I want to buy that apartment complex. I'm in.
You don't need to know them. They can invest immediately.
But
there's one catch is they don't get to self-certify. You have to have a third party certify that they are accredited. There's no non-accredited investors, no sophisticated investors. Everybody's got to have the financial wherewithal to take the risk with you.
So how do you get somebody to do that? Who certifies these people?
Yeah. So, from my experience, I have my attorney write up a letter that just says, that verifies the accreditation. And then I hand that letter to my investor. They said, hey, I'm accredited. I'm like, sweet, have your attorney or CPA sign this letter that my attorney drafted for you. And then we're good to go.
I see.
So you just need a verified third party. There's websites out there that do it, like, verifyinvestor.com. You pay $20, you submit your documents. They have their attorney sign the paper. But generally speaking, you need a certified financial advisor, somebody who's passed the Series 65. You need an attorney or you need a CPA to sign this letter verifying your accreditation status.
Yeah, when I've invested online and in some crowdfunding sites, they use those online, verifyinvestor.com or whatever it is.
It's pretty easy.
And I have to upload documents. They review the documents. They may even call me to make sure that the documents are in line, and then they certify me.
Yeah, the SEC cares a lot less about millionaires than they do people under that $1 million mark. It's the rules are built to govern and protect these people from soliciting millionaires in a Walmart parking lot. I mean,
yeah, that's right. This is to protect the general public from getting swindled. I mean, I'll be honest. There's been a couple deals that I've gone into where the sponsor wasn't 100% truthful in what they were doing, and the deal didn't make money. And now it was a really small portion of my net worth that I had at risk, so it's okay. But a lot of times, non-accredited investors, if their net worth is $100,000 or $200,000 and they're trying to put 25 grand, 50 grand, it's a huge percentage of their net worth, and it'll be a big hit if it doesn't go well. So this is all to protect them. That's why in the 506B, which does take some sophisticated investors, they want that pre-existing relationship, so you know who you're dealing with. Yeah, right. You're not just you've never met this guy before, and he's putting the hard sell on, and he's like, you got to invest today, or you're gonna miss it. Yeah, that's why at worst they have that 30-day cooling off period.
Yeah, so we just went over the 3 easiest, most common ways to raise money in commercial real estate. You're probably going to start off with a joint venture, just filling out an LLC with the state, getting an operating agreement with you and your buddy fixing and flipping this house. You don't have to file anything with the state, besides your LLC. Yep. You don't have to raise any money or do these complicated documents. It's super easy. The next step, after that, you're going to get bigger investors. You may go to friends and family or rich uncle or grandpa or something like that and, pull together some capital. They're super limited, the investors. They're not doing any of the work. You're doing more work. You're getting kind of more profits for doing that work, and you're raising more money. At that point, you're probably in a 506B. Need to get an attorney at that point. And then after that, right, you've probably tapped out all of your friends and family's money after, a few 5 years in deals. It's not like you've lost it, but it's tied up in deals. You're probably starting to look for more investors out of your local area. You want to start advertising, and then you're probably going to progress into 506C. Interrupted by a brief phone call. Sorry about that. Anyway, you're going to move on to 506C because you can advertise, but you can only take accredited investors. So just along the way, as you take more money and different types of money and bigger deals, there's just a little more paperwork, but it's fairly easy because it's the same attorney who can draft all of this, same guy. You can change deal structure. You can go back and forth. We have a 506B right now. We have 506Cs right now, and we have joint ventures right now. So you can do all of them, coterminously on different deals.
And we'll get into the more of the details in some future episodes, because I know people listening, I know at least before I did one, it just feels intimidating, but it really isn't. All you need is the right attorney, a deal, because any good deal will raise the money, and maybe a mentor or a partner. So,
fear of the unknown. So we're taking that unknown to known, how to invest in commercial real estate. I mean, that's what it's about.
Yeah. All right.
Alrighty. Well, if you haven't already, make sure to go grab the free LOI download from our website. You type in your email address, you get our free letter of intent that you can use for all your deals. It's invest.howtoinvestincre.com, and make sure to like and subscribe. Thanks for watching, listening. We'll be back in a few days. Thanks, guys.
All right.
Thanks.